Hello, Chris. It's starting to make me nervous that nobody else was joining, including the speaker, who I just chatted with, and so hopefully he will join. Hello, Vivian.
Hello, Daniel.
Yes, Chris says it's still early, and I agree. I just get nervous. Particularly when the speaker is a little late, even though we just chatted. Hey, Chris, your video is on, but we're not actually seeing anything. I think there's a cover over your camera, but the video is on. Ah, okay. Hello, investors and everybody at the Intel REI Club. We are, Jacob, I see our speakers here. Excellent. It always makes me a little nervous. I followed up with Jacob about 30 minutes ago. So it's a little bit of my own fault that I'm nervous here, but I usually have a little chat with people ahead of time and make sure that they're going to be there and provide the HR rules and all that sort of thing. But Jacob, we're glad to have you here. We're going to wait just a few minutes for people to join. I wanted to let people here know that, let's see, currently we've got, I think, a little over 140 people registered. We'll see how many of those actually attend. So a couple of housekeeping not rules, but announcements ahead of time. First of all, you all know that we've had some difficulty with Microsoft Teams whenever people join our real estate investment education channel. For whatever reason, the administrators, or maybe just ghosts in the machine, are removing people from our channel. And so I have officially given up on the idea of using Microsoft Teams for that purpose. And since I'm not using it for that purpose, we're just using Zoom now. So we are going to still try to find another way that we can all chat together as a club to share, just tips or tricks or, thoughts about whatever investment you're working on or a real estate agent you had a good experience with, whatever it happens to be. And I know last week somebody mentioned Discord. And so I want to look into Discord. If anybody has any experience with Discord, I'd love to talk to you. I would be new to that platform and I haven't set up a Discord channel before. So if you have experience, please reach out to me. And the next thing that we're going to talk about too is that if you are new here, make sure that you go to our SharePoint site. And let me share that right now. I had a number of people last week who said that they were new to it. So I will bring it up right here and just make sure that everybody on this call knows about it. But it is at right here, Intel SharePoint Sites Real Estate Investment Group. And I'll just drop this into the chat. If you want to go back and find out our previous speakers or visit our Speakers Hall of Fame or see the upcoming meetings, which are being updated as we speak, please go to this site. There's also a video here that'll walk you through how do you subscribe and unsubscribe to the Real Estate Investment Education Club at Intel. And just to make sure, I haven't heard a peep on the line, which might be good. Can you all hear me?
Yes, Daniel.
Okay, good. Excellent. All right. And so with that, I am going to introduce Jacob. Jacob, actually, why don't we have you? So I was introduced to Jacob from a friend of mine who works at Dell and has been working on the Dell Real Estate Investment Club over there. And so we were introduced by a mutual friend. And I know that Jacob is in self-storage right now. In times like this in the economy, I'm often looking at areas that are not as competitive as some of the single family or Airbnb or multifamily properties. And self-storage is one of those areas that is still seeing great returns. And it's a very interesting business model. It's somewhat simpler to a certain extent than places that actually store people, because you're storing stuff. But I will let Jacob introduce that. Jacob, welcome to the club.
Daniel, thanks for having us on today. Good to see everybody. We're happy to be here. We love talking shop about real estate. We can talk self-storage. We can talk single family. We did a lot of single family fix and flips over the years. We've done single family development. So anywhere we want to wander today that's helpful, we're happy to go there. We're a private equity shop based out of Denver, and we got started investing in real estate full time in about 2006. We did over 1,000 single family fix and flips from about 06 to 16. We got in the self-storage space in 2015. We like the fact it's been historically recession resistant, it's scalable, repeatable. So we developed our first round of deals about 7 years ago here in Denver. We're actually selling those at the end of this month, next week. And those leased up fairly well and stabilized. So we did some more in the Midwest. Typically leading up to about 19, we were doing syndications for our storage deals. We launched our first storage fund in June of 19. We closed that in August of 20. And we launched our second fund early in 21. We closed that in Q1 of this year. And we're launching our third fund here pretty soon. We've got 37 self-storage facilities around the country, about 235 million in total capitalization, at least until the end of next week. That's about 18,000 units. So it's been a fun business. It's performed really well during times of disruption. Obviously, we've had a lot of disruption in the last couple of years. But just like the single family space and multifamily, it's become very competitive. Cap rates are compressed, deal flow is challenging. So if you own stuff, it's good, but trying to find new product is difficult these days.
All right. So I will make sure to monitor the chat for you. If you have questions, put them in the chat. Jason, do you have a presentation, or do you just want to do a conversational style interview?
Yeah, we could. We could do a presentation if you want. I could kind of walk you through a development deal example. It's a PDF, but we were planning on just kind of keeping it conversational and have it flow.
Okay, sure. So, the topic on the meeting invite is self-storage. So perhaps you can introduce us to the concept there and why it's a good business model.
Yeah, self-storage is a kind of a unique asset class within real estate, and there's a couple reasons for that. One reason is the revenue management is very dynamic. And by that, I mean, all of our tenants are on month-to-month leases. So you can respond real time to supply and demand changes, not only at the facility level, but at the unit level. So let's say you have a 10 by 10 unit type that's really full. You can raise rates with a 30-day notice to your customer base, and $10 a month is probably not a lot to your customer. They'll probably stay. But if you raise rates $10 a month on 600 units at a time, and you annualize that and you put a cap rate on it, you've created a lot of value. So the revenue management's very dynamic. We definitely like that aspect of it. And for the most part, we've got climate control deals, we've got non-climate control deals, we've got multi-story properties with elevators, single story drive-up units. But for the most part, the operations across each facility is very similar. Repairs and maintenance are pretty low, operating expenses are low, salaries and wages are relatively low for your on-site managers. And it's proven to be a pretty defensible asset class. A couple things we look at, we're considering a self-storage acquisition. One is supply ratios. So if you're looking at a storage deal, storage is very sensitive to local supply. So we'll track supply ratios in the 1, 3, and 5 mile trade radius. Nationally, there's about 8 square feet per capita of self-storage. And historically, if you're in a market that's well over that market could be oversupplied. If you're underneath that figure, that market might be ripe for new development. So we're looking at supply ratios pretty carefully. The second thing we're looking at are market rents. So if we're buying an existing facility, we're looking at the historic revenue stream on that facility compared to other market comps. It's like underwriting a fix and flip, right? If you're looking at a deal and you're looking at comparable properties, if a deal you're buying is 2,000 square feet, it's a 4-bed, 2-bath, it's a ranch. You're looking at other 4-bed, 2-bath ranches, what the values are fixed up, what the values are distressed. And we're doing the same thing on rents. So we'll analyze what the market rents look like. And the deals that are interesting to us is when there's a story of the facility being undermanaged. So believe it or not, in self-storage, if you're highly occupied, over 90%, 95%, your rates are probably too low. So in the self-storage industry, having customer churn is not necessarily a bad thing. When you get a new customer to move in, it's a new opportunity to raise rates, to raise your street rates. It's a new opportunity to sell that customer some of your ancillary revenue stream products like boxes and tape, tenant insurance, one-time admin fee when they move in. So we'll look at facilities, we'll identify ones that have undermanaged rates, below market rates, above market expense loads. Sometimes the owners don't even have a website, and we'll come in, we'll rebrand the property. We'll put some capital improvements into it. Typically on a standard acquisition that might involve seal coating the asphalt, gate systems, new gate keypad to get into the facility, new security cameras, new doors, new roofs. But typically our capital improvements on a standard acquisition are not too heavy. Most of the value creation is going to be in the revenue management side. So we'll buy a deal within 6 months, we'll start raising rents on existing customers. And that's really what we're up to. And that's kind of a quick overview of the storage space. I'm monitoring the Q&A here. Daniel, if you have something, feel free.
Oh, no. Well, Glenn hit the question that I was going to ask next, and that is, we've seen an increase in the number of franchises quite a bit in the last 10 years. Which is better from your perspective to take over ownership from, a non-franchise or a franchise? And how do you evaluate the difference?
Well, by franchises, Glenn, what you might mean are some of like the nationally traded REITs like CubeSmart and Extra Space. So when we first got in the business, we would look at Cube or Extra Space managed properties and think there's no meat on the bone because they know what they're doing. Well, we were also to manage our properties for us at the time, early on in our storage careers. And, they dazzled us with their revenue management, their algorithms, their online marketing. And what we found after the honeymoon was over is there's a lot of revenue that is going in their pockets. It's not going in ours, like tenant insurance. We also found they're not paying attention to the operating expenses as much as an owner would because they're a third-party management company. So believe it or not, there is still arbitrage in buying deals that are managed by the national REITs. It's not, with that being said, it's pretty rare that we'll buy something that's managed by CubeSmart or Extra Space or Public. We do buy deals occasionally that were managed by Extra Space, but most of our acquisitions are mom and pop ownership groups and management platforms. So there's arbitrage in both, though, I guess is what I'm trying to say. As far as the profitability on the deal type, it really depends. Let's use the example of a multi-story elevator access self-storage facility. First of all, they're expensive to build. And from a customer service perspective, if you have the option somewhere nearby at a lower price where you can drive up to your unit and load and unload and just leave, you're probably going to choose that option over going into a building where you have to push a cart 100 feet, wait for an elevator to come, wait for the elevator to go up, push your cart another 100 feet, and then rinse and repeat as you load and unload. So multi-story climate controlled deals typically perform better in very dense infill locations. There's some suburban product that does well, but if you're going to build a big bomber facility like that, it's first of all very expensive. So you have to have the rents to support it. And you really got to feel comfortable that there's not a lot of supply in that submarket, and customers are going to have a lack of options. So they're going to have to ride an elevator to the third story if they want to store somewhere within 2 or 3 miles. That's a big consideration on those. Generally speaking, operating expenses on a larger deal are a little bit higher, especially if it's climate controlled. You've got utilities, you're heating and cooling the building. You've got more staff to staff a bigger facility. But we do all types: single story, small, drive up, non-climate controlled, multi-story climate controlled. And really just kind of depends on the markets and the revenues that are in place in those markets that can support it.
There's a question in here about turnover costs and evictions, and what percentage or what sort of expense does that actually drive at the business?
Yeah, in self-storage, I'm going to sound like a dirty capitalist here, but in self-storage, there are no fair housing laws. So you have to follow the rules in the local market. But typically, if a customer doesn't pay, the first line of defense on the ownership side is to turn off their gate code. They can no longer come into the facility. If somehow they do get in, they follow a car in, whatever the case might be, the second line of defense is to overlock their unit. So if they do get to their unit, they can't unlock it. They've got a red padlock on it. They have to call you up to get the lock removed. And the final line of defense is to actually evict the customer. a lot of our customers that will buy, rather that lease in existing facilities will inherit pretty heavy customer delinquency from ownership groups that don't monitor it very well. So we'll have pretty heavy delinquency and evictions in the first 3 to 6 months when we take over a new property. And from there, our delinquency rate generally stabilizes to about 2.5% to 3%. So it's fairly low. But when someone doesn't pay, it's fairly easy to get them out. You get the unit back in service to a paying customer. You don't have to go through the court system. So it's fairly straightforward. As far as turnover costs go, they're really low. I mean, if you're turning a single family rental or an apartment unit, for example, you might be doing carpet and paint. You might be doing some miscellaneous repairs. We're leasing steel boxes out, and the amount of damage that someone can do to that steel box is pretty minimal. So our most expensive turns are really when someone leaves a bunch of stuff behind. We have to hire a crew to go remove it. Thankfully, if we actually go all the way to an eviction, we run auctions, which I'm sure you've seen on reality shows. And the auction buyers, if they do buy something inside that unit, part of their deal is they're required to remove all the contents and broom clean it. So a lot of our auction buyers will take care of getting the unit back in service for us. So turnover costs are relatively low. And the eviction process, depending on the state, is fairly simplistic.
What are some of the determinations that you have when you're choosing a location for self-storage? What would an ideal location for it be? Is it inner city? Is it suburbs? Is it on the outskirts? Where do you find your best profit?
Just really standard good location nuts and bolts that we all track in any deals that we look at. Beyond the supply ratios and the rents in the submarket, we look for just housing density. We don't like to buy locations that are overly rural or in really small towns because, if you return to the supply ratio example, let's say you buy a facility in a town of 10,000 people or 20,000, whatever it might be full, but a farmer gets in his head, I'm going to build a storage facility on my farm. Your supply ratios, get way out of whack quickly. So we generally stay away from smaller markets. As far as dense infill locations go, really the only arbitrage we're finding right now in dense infill locations is development. If you're buying an existing facility that's stabilized in a primary market, you're probably paying an in-place cap rate of like a 3, and that's very low, especially with what interest rates have done. So most of the deals, if we're doing an existing acquisition, they're in secondary and tertiary markets. We got a lot of deals in Pensacola, Florida, Charlotte, MSA. We've got some deals east of Memphis, Tennessee, Columbus, Ohio, a bunch in Wisconsin, Illinois. So we're generally targeting the secondary and tertiary markets, and we found those deal types are a good blend of current cash flow with more potential for capital appreciation as well.
So with this question, we could probably open it up to different asset types also, but I'm going to ask the question, why should somebody invest in self-storage over a different asset class, single family, multifamily, or something else?
Well, until recently, given how much cap rates have compressed, self-storage from a cash flow perspective has generally performed better than multifamily, just because multifamily cap rates have been compressed for so long. Self-storage cap rates are getting there. They're not quite as low as multifamily cap rates, but they're definitely getting compressed. It's really just kind of what your appetite is. I love the multifamily space and the workforce housing space in general. I think especially today, our country is shifting from a nation of homeowners to a nation of renters. People who were almost able to buy a house 4 months ago with interest rates the way they were are suddenly priced out after rates go from a 3 to a 5. So they're going to be renting for the foreseeable future. So I think being in that space is a good place to be. Just kind of depends on what your appetite is for risk and what your investment targets are. Our main thesis on every deal that we buy or build is always the path to cash flow. So we're very, very hyper focused on cash flow. And I think all sins in real estate are cured if given enough time. And the question is, can you hang on to get to that time point? And the way you do hang on is cash flow. Enough cash flow to cover your expenses, your mortgage payment, and cash flow is really what our target is on all of these.
So Anita is asking, is there an area in the US where self-storage does best?
Yeah, It's really cyclical. It kind of depends on the market, which is kind of a cop-out answer, but I'll try to expand on that further. Denver is a good example. So Denver became really oversupplied starting in about 2017. A bunch of developers at the same time had the same idea. They built projects blocks away from each other. They all came out of the ground at the same time. And what happened was rents went from here to here in like a 6 or 9 month period. It was very sudden. So that's an example of how oversupply can kind of shock rates in the submarket. The markets that we like in general, we like the Midwest and the South a lot. We've got a deal in the pipeline in Orlando, Florida that closes in about 2 months. We've got some acquisitions that are going to happen in Georgia and South Carolina later this year. They're actually being built now. We're going to buy them at certificate of occupancy. And the primary markets work too, like the coastal markets work, but most of the time you have to build there to make a project make sense. And the entitlement process, if you're building a new storage facility, depending on the market and round numbers, it'll take you a year to get it approved. It'll take you about 12 to 15 months to build the property. And then after it's done, it'll take you 2 to 3 years to stabilize it. So it's a long runway. Development is a totally different game than buying an existing facility with in-place cash flow.
Do you have a preference to only buy existing facilities?
We're doing both. So in 2021, we bought pretty much exclusively existing facilities that were already there. They already had in-place occupancy, and we add value just by revenue management, raising rates, raising occupancy levels. We developed a number of projects, like as I mentioned, some number of years ago, and we're finding that the opportunity to build is really there now again. So we've got 4 big development projects in our pipeline right now in the Denver market. One's going to close in July, and the rest are roughly late Q3 through Q1. And these are infill, difficult to replicate sites. We've had them under contract since Q4 of last year, so it's a long runway. So to more concisely answer your question, we do both, but it kind of just depends on your capital stack, your investor appetite for risk, whether your investors want cash flow or they want more growth. So it just kind of depends on the strategy.
Do you have a certain level of debt that you usually go to? Is it similar to a single family home where you're putting 20% down, or is it slightly different?
It's a little bit different. Debt, when used responsibly, can really increase your returns. But the problem with debt is debt does not make a bad deal good. Debt makes a good deal great. It doesn't make a deal that would otherwise be bad a good deal all of a sudden. So we try to be fairly conservative in our leverage assumptions. We generally lever at between 65% up to 70% of total cost. I think we're averaging around 65, 66 last year. Our development projects will be around 63 to 65. So somewhere kind of in that sweet spot. And, if you lever up and let's say you go to 80, which is really tough to do with commercial banks anyway, but let's say you could go to 80, your returns on your equity are going to be juiced substantially if the deal goes well, right? Debt's cheaper than equity. The problem is if it doesn't go well, you can't make your mortgage payment if you're levered too high. So those deals could be home runs if they go really well. If they don't, you could have a big cash flow problem. So we try to kind of be defensible and keep it between 65 to 70%.
Rodney's got a question here about, are you a syndicator? So in other words, do you bring in individual investors and group them together into an LLC and then run your properties or get your debt finance or your equity financing that way? Or do you deal with private equity firms that will stroke you a big check? How do you finance your equity?
Yeah, we do all of the above. So we do 2 different deal types. We do single asset syndications and we do funds. And the nuts and bolts of both are pretty similar. The main difference is a fund, as you probably know, is a collection of assets. We generally gravitate towards the fund structure. Most of our deals are in funds. And the reason we like funds is the geographic and the cash flow diversification that a multi-property portfolio offers versus a single asset syndication. So if you invest in one single asset syndication, deal doesn't go like you thought it would. There's nothing else to prop it up. It's just that deal. Whereas a fund, let's say you have 10 properties, inevitably quarter by quarter, one property falls behind forecast for whatever reason. Well, balanced out by the income streams for the other 9, and then one of those 9 fall behind forecast, and the one that was behind forecast goes ahead of forecast, and they just kind of balance each other out. So it's a little more diversified. In our development program that we're launching, as I mentioned, we have our first land acquisition in July. Towards doing those in single asset syndications, just because development, people want to pick and choose their markets, get to know the deal a little bit better. They're not buying into any existing revenue streams. It's in fact a negative return, right, for the first couple of years, because all you have is expenses with no revenue. So syndications allow investors to kind of pick and choose their locations a little better. But as far as how we source our capital, we have a pretty broad range of investors. We've got anybody from a guy that's a CEO of a publicly traded company that's probably worth $500 million, to horse jockeys, to just real estate entrepreneurs who want exposure to the storage space, attorneys, healthcare providers. Really investing privately in real estate or in syndications or funds allows people to participate in an asset class that they're not going to go out and necessarily do on their own. I mean, really the 3 ways for you to invest in self-storage are: 1, you can buy a REIT stock, and that's great. The nice thing about buying a REIT stock is it's liquid. You can sell it and you can get a wire transfer to your Schwab account the next day. You're done, you can get your money out. The main downside to buying a REIT stock is you've got, first of all, you're at the mercy of the stock market. The REIT could be doing really well, but the market decline drives that REIT stock price down. The second disadvantage is you're not participating in any of the tax advantages that come along with actually being having an ownership interest in an LLC in a private vehicle. So you're not getting the depreciation, which really is to offset your taxable income from distributions. So one way is to buy a REIT stock. The second way is to do your own storage deal. Right, you got to commit to that though. It's a questionable ROI on your time. You probably don't want to just do one. You want to get scale to it. And the third way is to invest privately with groups like us and many others in our syndications or our funds. There's a lot of good operators out there. I think we're good too, but a couple that come to mind, Reliant out of Atlanta is a really good shop, Reliant. And then Spartan, they're actually in our own backyard. They're in Denver here. We just had lunch with those guys today, kind of comparing notes on best practices.
They'll actually be here in 2 weeks too.
Oh, cool. Yeah, they're good guys. Another good group is 10 Federal. They're in the Southeast. They have a lot of facilities in the Carolinas. There's a lot of good groups out there that do this. Let's see here. One question.
Question on K1s.
Yeah, K1s. That's a great. Ashish, how you doing? So the taxable, the K1 aspect of this, let's say a fund is in 10 different states, and let's say an investor invests 50 grand and he's getting, call it $4,000 a year in distributions before there's appreciation and some kind of reversion event. He might pay his CPA a filing fee that's pretty substantial to file in those 10 states, and his 4 grand might turn into 3 grand. So his return goes down by 25% just because of tax filing fees. So we offer a composite filing for investors in multiple states. We won't get too far in the weeds on this because it's kind of nuanced, but different states will allow for composite filings depending on their rules. Some states don't have state income tax, like Florida, for example, or Texas. But we'll do composite filings for states for investors who elect to file composites in those states, which basically means we're filing the tax return on your behalf at no expense to you. So now one last comment on composite filings. If you're looking at syndications or funds, mainly funds that are in multiple states, if you have other taxable activity in that state, you cannot file a composite return. So you're automatically disallowed if you have taxable activity in, say, Michigan. Outside of the fund you invest in, you can't file a composite return in the fund. So that's kind of one way to navigate it. But again, the rules are kind of state by state. So one question too, 506C or 506B. So for those of us on here right now who may not exactly know what those are, a 506B is in Bravo designation, allows a certain number of unaccredited investors into the entity. The disadvantage to it is you can't generally solicit, which means that we couldn't go do an email campaign to someone we don't know or haven't met before. All of the relationships have to be pre-existing. So you kind of have to, there's some gray area there with the SEC on what pre-existing means. We don't like to operate in the gray, so we always do 506Cs and Charlie designations. And what that means is
Hey, Toby, how's it going?
we can generally solicit to anybody.
Okay,
But we can only accept accredited investors. You have to get a copy of an accreditation letter, basically from their CPA or their attorney or their financial advisor, stating they're accredited.
Okay, if you have any questions, feel free to put them in the chat. I actually wanted to back up to your income value add services. You mentioned tape and boxes. Can you go through and elaborate a little more on what all of those different services are and how much income do they actually bring to your bottom line?
Yeah, so I'll walk you through that for a moment, and I can I'll pull up a summary here, and while this loads, I'll start explaining what these are. But this might be interesting for everybody to see, just kind of an example of a storage portfolio. So our ancillary revenue streams within our asset base make up about 8% of our top line revenue, which is really meaningful. And those ancillary revenue streams, there's a couple of them. One is late fees, and that's self-explanatory. If a customer pays late, they get a late fee. Another ancillary revenue stream is tenant insurance, and I'll spend a moment expanding on this. So we require our customers to either present proof of coverage on their unit via their homeowner's policy or buy a protection plan from us. So believe it or not, in self-storage, in the traditional self-storage lease, the lease states that the owner of the building is not responsible for your contents. So if there's a fire, theft, or flood, we're not responsible for your stuff. So we require you to either show insurance or buy insurance from us. So we pay our carrier $2 a month in premium for our customers that are on our protection plan. And we charge our customers between $12 to $15 a month for $5,000 to $10,000 in coverage. So make the numbers round. Let's say it's a $10 a month delta. Now, that's not a lot of money, but kind of like I talked about earlier on rate increases, if you get 65% of your customers in a given facility to buy your protection plan, and you've got 700 units, you have $10 a month per unit in arbitrage there, or net income. You annualize that, you put a cap rate on it, you might have created $1 million in value from a cap rate perspective. So the first one, again, was late fees. The second's tenant insurance. The third one, which is not as big, but still adds up, is a one-time administrative fee. So when a customer moves in, depending on how the deal's doing or the occupancy, we might offer them like a second month free or a half first month free. But they have to pay a one-time move-in fee of $25 to $50, depending on the deal. It only happens one time. Again, it's not a lot of dollars, but if you have hundreds of move-ins every month across your asset base, that can become fairly meaningful. And the final piece of our kind of ancillary revenue stream is what you mentioned a moment ago, Daniel, is boxes and tape and miscellaneous like packing materials. That doesn't make up a big piece of our revenue. A number of our facilities are not staffed, and that's by design. Our technology platform allows someone to lease a unit online, make their payment online, get their gate code online. But our deals that are staffed with a traditional leasing office, we do sell boxes and tape there. It's a meaningful number, but it's not as big of a number as the other three. So this right here, I can show you a quick example. This is I'll try not to get too far in the weeds here, but this is an example of a management summary from our Fund 2 portfolio. And this tracks a couple interesting metrics that we watch on a daily basis. So one number is net rentals, and that's the delta between the number of move-ins and move-outs across that given portfolio. Now, if you're in a portfolio that's not really stabilized yet, you want your net rentals to be pretty heavily positive because you're growing occupancy over time. So this is month to date for May, by the way. A couple other metrics there is occupancy. So this one's obvious. What percentage of units are occupied? This one is what percentage of square feet are occupied. So that number can be kind of different depending on the unit size, the unit count. Some deals that we're really heavy on parking on will generally have higher square footage occupancy than unit because a parking space is a lot of square feet, right? And then the last one is economic. So economic occupancy is your in-place revenue as a percentage of your targeted stabilized revenue. So this portfolio, I think it was in the low 70s early this year. It's up to 81 now. So said otherwise, we're 81% of the way towards our economic occupancy target. And to return to the original question, kind of why I pulled this management summary up, these are examples of our ancillary revenue streams. So fees right here, inside of fees are late fees and administrative fees. So year to date through today, it's just under 150 grand. Merchandise sales, again, not a huge component, 10,400. This is a really tiny one. And insurance, you can see how meaningful that is, $176,000 in insurance revenue. So let's say if you annualize that, this math won't be exact, but pull up your calculator here. Let's say that $176,000 was realized over 2.5 months, roughly. I'm sorry, over 4.5 months, year to date. That's $39,000 a month in tenant insurance. So you annualize that, you've got $469,300 per year in tenant insurance revenue, and you put a cap rate on that. You've added $7.8 million in value at a 6 cap valuation just by selling protection plans to your customers for a $10 a month spread. So it really moves the needle. It's amazing how sensitive NOI is and cap rates are, especially as cap rates compress. It becomes exponentially more meaningful as cap rates go down.
All right, Ashish and Glenn seem to be our questioners here today. And Ashish is asking, what's the long-term impact of changing interest rates on your cash and IRR projections?
Interest rates, of course, is a big topic of conversation for all of us today. Lenders are feeling it too. They get loans out, so they're actually getting more competitive than they were maybe this time last year, just given what rates have done. So interest rate impacts are meaningful. So let's do, I don't want to get too far in the weeds here, but we might as well just go down a quick rabbit hole and I'll give an example. So I'm going to open up a blank Excel spreadsheet, and Daniel, if you find this is not helpful to the group, just stop me. I'll try to make this quick, but we just want to drive.
You're talking to the wrong person. I like spreadsheets.
Okay, cool.
There's probably others here that do too.
All right, so we've got a blank spreadsheet here. Okay, so property basis, we'll say, is $1 million. Okay, just make the math nice and round here, and you can see my my lack of Excel skills real time. Let's say loan amount on this property, got this thing levered. Let's just say it's at $700,000, 70%. Get my commas in here, and we'll say our interest rate is, let's say it's back, this time last year, our rates were about 3.5%. So we'll do 0.035 in this cell. Annual interest carry in this scenario is obviously 700 times 0.35 rather, 24.5 a year. Let's say our net operating income on this property, let's say we're in it for, let's say we're in this deal for a 7% cap rate, something like that. So we'll do this times 0.07. So we have $70,000 a year. Our net cash flow is NOI minus annual interest carry, so 45.5 a year. Our equity in the property, because we bought it for $1 million, we put 300 grand down, is 300,000. So our equity dividend yield in this scenario, or cash on cash yield, is going to be 45.5 over 300. So we're making a current dividend yield in this scenario of 15.17%. Now, let's say we increase these interest rates, the interest rate on our loan from 3.5% to 0.0 to 5%. So you have a big decline in your equity dividend yield. You go from 15% to 11.6%. So it's a meaningful impact. Where you're not catching as much of the impact is on the reversion. So let's say you're buying a deal and you're solving to a 20% internal rate of return over the life of the project. So if we're buying an existing deal, roughly half of our total investor return comes from distributions from cash flow along the way, and the balance of that return comes from some kind of reversion event or disposition event. So the dividend yield along the way will go down because of that increased cost of capital. But all things being equal, say cap rates stay the same, which I don't think they will. They're going to have to go up eventually. You'll still catch that pop at the end. But said differently, increased interest rates and compressing cap rates will absolutely affect cash on cash returns, IRRs, and multiples. And we're not seeing, there's so much capital that wants to be in the storage space right now, much like multifamily and industrial and some others. Despite the fact that interest rates are increasing, we are still seeing trends of cap rates compressing. And eventually that math breaks, right? Eventually you can't pay a 3 cap anymore when your debt's a 5. Just doesn't work. So we're not seeing prices decrease yet or cap rates increase yet, but assuming this interest rate velocity continues, we're definitely going to be seeing that sometime in the foreseeable future.
I wanted to ask you a little bit more about the expenses that you need to pay. Of course, there's tenant turnover costs, which we mentioned, but what other expenses do you have? Is there landscaping? Is there, payroll? Go through the other expenses.
Yeah, I can pull up our income statement for Fund 2, if that would be helpful, and just kind of give you guys a couple visual examples. Again, I don't have a presentation prepared, but pulling stuff up on the fly is maybe more valuable to a degree. Couple examples as I pull this up. Repairs and maintenance. Let's say a RV runs into a door or a gate. We have, I would say, once a week we have a car crash in one of our gates somehow. They forget that it's closed. They back into it. They pull forward. Whatever the case might be. Other expenses are salaries and wages for our on-site people. We have our on-site staff members that are actually at the facility on our deals at our staff. We have area managers, regional managers, and we have our corporate office. So those expenses are allocated kind of pro rata based on how many facilities they oversee. Utilities, obviously those are a lot more expensive on a deal that's fully climate controlled versus a deal that's non-climate controlled, which is single story drive-up units. And one big piece of our expense load, and it especially is big in higher property tax markets, are property taxes. And that's one thing that we try to be really careful about when we're underwriting properties. If you buy a deal and you're not forecasting that property tax increase correctly, you can really get beat up from an NOI perspective. We kind of showed how sensitive interest rates were. Well, imagine you're buying a deal, you're going to stabilize it to an 8 cap with $200,000 in property taxes, and those property taxes come in at $350, and you're not expecting it. That's a big problem. So just briefly here, this is our Fund 2 income statement for the month of April. This will kind of give you an idea of how this lays out. So on the top here, you've got the revenue side. This is the gross potential income here on the top right. Then you back off concessions and discounts like move-in specials, your vacancies, loss to lease, and then you add in your ancillary revenue streams, which we spun through a few minutes ago right here. And then sometimes we'll have like an lease to somebody. A couple of our projects have a small retail component with like small mom and pop retailers on the front of the facility. Those will go under commercial income right here. You can see total revenue for the month of April is $825. And then on the bottom, you've got expenses. You've got marketing, auction services, dues and subscriptions, professional fees, general administrative, property management fees. You can see our landscaping, maintenance, pest control, security, snow removal is a big one. Apparently it snowed a fair amount somewhere in April, $24,000 right there. Trash service. You guys can read these for yourselves, but these are kind of examples of the expense line items in self-storage that are not that dissimilar from multifamily or anything else. Let's see, another question here. Sorry to hijack you, Daniel.
Go for it.
Let's see, a typical deal to give us an idea of how you handle returns, cash flow equity, maybe an example of each, targets we look for relative to the risk to compare with other real estate asset classes. Yeah, it depends on, I keep saying this like a broken record, it depends on the deal, right? So I'll pull up this deal that we're raising capital for right now. That's a development project here north of Denver in Longmont, Colorado. So let me get this slide deck pulled up here. So I'll give this example, then I'll just verbally walk through another deal example that's kind of the polar opposite. So this deal here, you can see is the subject property that we're going to build, some project strengths, high traffic counts on the highway next door. The total project cost about $14.9 million. We're going to build this to a 7.6% yield on cost or cap rate. We're targeting a 227 equity multiple and almost a 19% IRR over a 5-year hold. So one reason this deal is very different from a value at existing acquisition is really this. You can see here, year 1, you're building. Year 2, you open the store, you start leasing. Year 3 is lease up. light distributions begin in year 4. You stabilize in year 5, then you recapitalize or sell. So said otherwise, this deal example, almost all of the investor return happens at the reversion because there's not a lot of cash flow to distribute along the way. Now, other deal types that we'll buy, for example, are deals in Fund 2. Fund 2 did a weighted average 10% dividend yield in 2021 on 8% in preferred return. And that's because we bought existing cash flow and we added to that income stream with effective management. So if investors want cash flow, they're not going to invest in our development deal because we have no cash flow. So in Fund 2, for example, our IRR targets are between 16 to 18. So they're still decently high, but they're not almost a 19. And that's because we're trading that return for more safety. Return is all about the implication and the perception of safety. So you're gonna pay a low cap rate for a triple net Amazon lease on some industrial building because you know Amazon's going to pay, and you're going to probably pay a pretty high cap rate for a multi-tenant strip mall in a bad part of town where the tenant base is a nail salon, a payday lending place, and users like that. So we try to kind of drive our return targets against the risk profile of the investment, and inherently buying an existing storage facility with historic revenues and historic occupancies is less risky than building something new, right? Because you've got years of expenses and no revenue. You've got kind of targeted estimated revenue streams that are going to occur years down the road versus looking at a seller's P&L and saying, all right, well, this guy did this much in NOI the last couple of years. All we got to do is gunch that up by 20%. We're in good shape. So the return profile should reflect the risk of the deal. This is a great question here. Would you recommend your own mother invest a portion of her life savings in self-storage now, or would you advise her to wait? That's great. Well, I've got a big chunk of my net worth invested in self-storage, and we're still buying and we're still building. I think none of us can time the market, right? We're all sitting on this call and we're thinking, man, I should have every fix and flip that I sold in 2012, I should have hung on to. I'd be rich, right? But you can't forecast the future. And I think pausing and doing nothing is one of the worst things you can do. Sitting in what the market's going to do. Let's wait till there's a decline. Well, that decline might happen, but it may not be very pronounced. And you could miss out on all this opportunity. All we have, our biggest asset on this call as people and investors is time. And sitting on cash and doing nothing with it, especially in an inflationary environment, I think is a bad move to make. I mean, you've got dry powder if the wheels come off the bus, but what if the wheels just kind of come off the bus? Or what if the bus just slows down? You're not going to go clean up. Like when COVID kicked off, we don't wish ill will on anybody, and COVID's a terrible thing. But in March of 20, we were terrified, just like you guys were, I'm sure. But we thought, man, we're well capitalized. We're going to see deals go on a fire sale, and we're going to buy everything we can when the market goes down. Well, we all know it went the opposite direction. With the exception of retail and hospitality, single family home prices have gone through the roof. They keep going. Self-storage cap rates compressed, multifamily cap rates compressed. So I would tell my mom to invest in self-storage, but I think choosing who you invest with is to a degree more important than the asset class you choose to invest in. I think if you're investing in syndications and funds, I believe that diversifying across sponsors is equally as important as diversifying across asset classes. Because you might invest with 5 self-storage sponsors and 1 or 2 of them don't do well, but the other 3 crush it. I think that's better diversification than investing with okay sponsors in multifamily, industrial, retail, you name it.
Atul's got another question here. How do multiple investors exit the fund, especially if the fund is invested in multiple states?
So exiting the fund, that's a good question. And to be clear here, Daniel, we are not pitching ourselves on this. I want to keep it educational, of course, but we just have a lot of examples from our own portfolio. People ask questions. I want to be able to answer them just from our own experience. So I'll describe some disadvantages mainly to investing in private real estate. The first disadvantage is you have a lack of liquidity. So if you want to get out and the fund's not ready to get you out yet, there's various mechanisms depending on the fund type, but liquidity is definitely not what it is if you sell your Amazon stock and you get a wire to your Schwab account. So the second disadvantage is you don't really have any control. You're a limited partner. If the fund's going to buy a deal in a state you don't like, you can certainly voice your opinion, and maybe the fund manager will consider that and not buy a deal, but you can't legally say, I don't want to buy a deal in Ohio. I had a bad experience there. So you have a lack of control, you have a lack of liquidity. And the third disadvantage, whether you consider this a disadvantage or not, is you're locked up for a while. You're stuck in the vehicle for as long as it's going to operate. Most fund documents don't have a defined end date. It's more of kind of a range based on what the market does. But with that being said, I mentioned all the bad things. The good things are that you're locked up, but you're getting cash flow. Whether it's cash flow today or cash flow tomorrow, you're going to get distributions. You got tax advantages. And depending on the capital structure of the sponsor's fund or syndication, you're going to have most of the upside in many cases. As far as how we get investors out, there's really three ways. So we have an 8% preferred return. And for those of you who don't know what preferred return is, or PREF, if you want to sound cool, PREF is a common element in under syndications that's designed to get investors the first round of yield before anything else happens. So in the case of our deals, it's typically an 8. Our development deals are a 10 because they're riskier, so we put a 10 on it. But after your preferred return is paid, every distribution above and beyond 8% goes to return your capital account. So that's one way you get out. And that's not going to be just a massive, there's not going to be enough cash flow to get you out in a year or two. But incrementally, that chips away at the capital account over time and reduces that investor's risk dollar for dollar. The second way we get investor capital back out is a refinance. And a refinance is replacing investor equity with bank debt. We did a refi on our Fund 1 portfolio in January of this year. We got lucky. We did it right before rates went through the roof. We locked in 10-year fixed interest only financing at a 4, and we returned half our investor equity back to our investors. That's the second way people get out. The third way is pretty obvious, and that's a sale or a recapitalization. And a sale is obvious. You sell in the open market, you get a new buyer. A recapitalization could involve bringing in a new source of capital at a new valuation and giving investors the option to stay in at a stepped up basis or have a liquidity event, pay their taxes, and kind of move on. So those are the ways people get out. But once again, if you're investing in something like this, whether it's with us or somebody else, generally you're locked up. There's a lack of liquidity, and you don't really have a lot of control over what the fund's doing. Another question here, it's a great one. What have been the biggest inherent risks that you faced with doing self-storage? There's a number of risks, of course, and we try to de-risk as much as we can. The thrill of buying a new deal is my favorite thing about my job. It's like dating a new girlfriend. I'm happily married, but the dream is limitless, right? Where can this go? And you've got your model, you've got your assumptions, and your job now, once you close, to go out and execute on those assumptions. I think the risk we've taken in buying existing facilities is pretty nominal. We're under-levered. We're in an asset class that responds really well to inflation, meaning we can respond real time with rate increases as inflation continues. But I would say the riskiest thing we're doing in the storage space is development. Development can be a wonderful thing, but it can also be terrifying and very risky. And the reasons are kind of obvious, but I'll touch on them briefly. Especially in this environment, you've got the risk of hard cost overruns, right? You could have a 20% budget bust. You'd have to bring in more capital than you expected, and it affects your returns. Steel goes to the roof. We all know about the supply chain issues and material costs, what they're doing lately. But I think the bigger risk in development right now, more so than the hard cost risk is the revenue risk. Are the rates that you're forecasting achievable and accurate? And to a degree, you're predicting the future. I mean, you're looking at market comparables today and market data today, and you're interpolating that data and making a conservative assumption in your model. But will those rates be there when you deliver this facility? And as we all know, commercial real estate trades on a multiple of the income stream it produces, or a cap rate basis. And if you're a little bit off on your NOI, it's a materially large delta in the total value of the property. So I think that's one of the, it's a quantifiable risk, and we defend against not hitting targets by being very conservative in our underwriting. But I think development is just inherently more risky than buying an existing deal that's been there for 10 years.
All right. Are there any other questions for Jacob? Feel free to take yourself off mute if you want to do that. And if not, hey, Jacob, can you give your contact information if somebody'd like to reach out to you?
Yeah, I'll put it in the chat here. They can email me, jacob@vanwestpartners.com, or go to our website, vanwestpartners.com, which I guess is also in the email. Yeah, if you have a storage deal that you've heard about, we'd love to hear about it. We're aggressively buying right now, but as I mentioned, deal flow is challenging. If you have questions on anything, happy to answer those, or just kind of compare notes on, creating wealth in real estate and quantifying the upside and mitigating the downside. We're always happy to talk.
And could everybody take themselves off mute and say thanks to Jacob for coming in.
Thanks,
Jacob.
Jacob. Very
Appreciate it.
informative.
Thanks, guys.
Thank you.
That was a lot of fun. I hope I didn't get too far in the weeds, but a lot of the concepts we covered apply to all real estate asset classes. They really do. We're all just trying to really do three things. We figure out what the property's worth when we make it better. We figure out what it costs to make it better, and then we back into what we can pay for it. It's just like a fix and flip.
Okay. Thanks.
And I will say it was like drinking from a fire hose to have you here. Thank you so much for all that insight, Jacob. And if you want to watch this again, we'll of course have it up on the previous Speakers Hall of Fame page.
Okay.
All right.
Bye. See you.
Have a great day, everybody.
Thanks for having us, guys.
Yeah.
Take care.
Hey, bye.